Hey guys, David Robinson here. Welcome to the apartment investing journey. We've got another great guest for you today. I'm really excited about diving into our conversation. I've got someone that has a tremendous amount of experience, has transitioned from the world of Wall Street to real estate, and has built an incredible business in the time that he's been focused on commercial real estate. And so I'm really excited to have Michael Episcope with me today. Michael, welcome to the show. Appreciate you coming on.
Thanks for having me, David.
Yeah, my pleasure. So Michael is principal of Origen Investments, co-chairs the investment committee and oversees investor relations, marketing, and company operations. He brings 25 years of investment and risk management experience to the company and believes that calculated risk-taking in inefficient markets is the key to building wealth. He regularly contributes to Forbes, Entrepreneur, and Huffington Post, as well as frequently speaks on real estate investment panels and podcasts. And so we're honored to have him on the show with us today. Michael, our podcast is all about the journey, and so we'd love to sort of hear the backstory of what you were doing before you got into real estate, and you've had an incredible career, basically two careers at this point in time. But let's back up. Let's talk about what your world looked like before you got into real estate and what you were doing and about the transition.
Well, David, I will take you all the way back to kind of where I first was introduced to real estate. And that was when I was, God, I had to be 10, 11, 12 years old. My grandfather was in real estate, and he operated properties on the west side of Chicago. And if anybody knows the west side of Chicago, that is not the good area that you want to be in. So he bought buildings out of tax sales in the 1970s. That's when, if you paid the taxes, you got the whole building, and you had to be scrappy in those days. And so I literally, I didn't even think about it at the time. I was just like to work. And, I was getting paid a few dollars an hour as a 10, 11-year-old. So I could buy my bicycle parts and do other things and have some fun. And I'd go spend the day with my grandfather. He'd turn me loose with a screwdriver and my cousin, and we would go in these buildings and do all kinds of, just pulling off door hinges and things like that. And you had to do that. You had to operate scrappy. So those were kind of my summer jobs. And that's how I got introduced to it. And then fast forward, I was on, I guess, for, kind of a lack of a better word, Wall Street. It was here in Chicago. Commodity trading was my first career. And that was at the age of 19 is when I started down at the exchange. And I didn't at that time know that it was going to be a career. I just loved it when I stepped on the floor the summer after my freshman year of college, and I stayed down there, and I decided to push all my classes at night. I actually went to school here at DePaul University in Chicago, and it really afforded me the opportunity to work during the day, take night classes, and start that career early on. And in the beginning, I really didn't know what I wanted to do, but I was getting trained in different things. I kind of figured out what don't I want to do. And I kept moving along. And I loved how dynamic it was. And so I was studying finance and econ, and I was seeing how the world operated from that standpoint during the day. And then ultimately in 1996, late 96, I stepped into the pits in 97, and I started my commodity trading career. And that just took off for me. All the training that I had prior up to that period really paid off. And I had a very steep learning curve and jumped in and just hit it hard for about 9 years. And I ended up retiring from that business in late '05 and got out. And I would say that, one of the biggest things that changed is when I went into the business, I was single. I had nobody to sort of look, into the mirror or report to or, hold accountable except for myself. And I didn't have any money either. So it was a very easy decision for me to do that. And then by the end of my career, though, I had amassed, a sizable amount of wealth. I was married. I had 2 kids. I had another one on the way. And I said, you know what, I'm done with this. I want to check out. I want to do something. And I want to take what I've built and I want to turn this into an income stream. And it was kind of scary because I retired really for about 3 months, 4 months. I was way too young. I was 35 years old when I made that decision. And the reason why I made the decision were computers came in. I just didn't want to, be in that risk profile anymore. So I went back, I got a master's in real estate, and it was all about taking my wealth and growing it and turning it into passive income. And at that time, my partner and I, we had already worked together on nonprofits and some other areas for a while. And we were just like-minded, and we were sharing investment ideas, and we both gravitated towards real estate and started investing more and more in that. And I would say that we had some good experiences, some bad experiences. The world was very different in, kind of, I would say 2006, 7, 8, 9. And I don't mean because of the great recessions. It was more because of the opportunities out there. And so what we decided is, look, we can build this. We can build something better. And we pooled our capital together, and not really with the intention of building a firm that we have today, but with the intention of, we just want to get into good deals. We want to have a fair shake. We want good fees. We want a good team, and so it just sort of grew organically from there. And I think the idea behind, when David and I were bringing a deal to our network and our friends, we're putting in 40, 50, 60% of the capital into those deals. And that really resonated with people. And that's how it took off, was really organically, up until, we sort of, I would call, formed the Origen and what you see today. So that's kind of the backstory and how I got here. But it was really out of a need, because candidly, if there were a lot of good options back then, and there were really, I think, investment firms that held the investor up first, I probably wouldn't have started Origen, right? But we just couldn't find it back then. It's not to say that it didn't exist. We just didn't find it, but I'm really proud of what we built today.
Well, I want to talk about your building of Origen and what it looks like today. But before we do, I want to go back to that time in your life when you were making this decision to, retire at 35. You had amassed a significant amount of wealth that you were wanting to turn into an income stream. Great problem to have, right? There's, I'm in a market here in Salt Lake City. A lot of great tech companies have rolled in. There's been, a handful of exits over the years, some significant exits. And so we have, some, younger individuals that are in what might be a similar space, right? Where all of a sudden they've been working hard, grinding away in their corporate lives, and they have an exit, and all of a sudden they have some money and they've got to figure out what to do with it. What was it? I mean, I know I'm taking you back a ways, but what was that experience like for you in seeking out a way to deploy the wealth in creating income streams? What was that process like for you?
Well, early on, it was networking and trying to go through the people who I really respected and picking their brain and getting advice. And I can relate to anybody out there who's had the exit, because you go from having a salary or being, you have both an income statement and a balance sheet, and all of a sudden you have a balance sheet. And how do you take that balance sheet and turn it into passive income? And that's the problem I was facing back then. So I can't say I did everything right. I made a lot of mistakes in investing, but not so many that it crippled me, and there's just certain lessons that you learn along the way. And unfortunately, the Mercantile Exchange, Chicago Mercantile Exchange, where I work, there was just some tragic stories about people who made a tremendous amount of money and went broke. And I think I've always had that fear of going broke. So I've been very careful with my money. And my partner and I, we say this, and we've said this since the beginning, the five words that nobody wants to utter is, I used to be rich. And that's what you have to really think about. Like, it's easy to get into an investment and really difficult to get out. And I would say the number one rule is invest with good people. Don't fall for pie in the sky pro formas, projections, things like that. Have an asset allocation strategy. I think real estate is just a great avenue to generate that passive income because of the tax advantages, the stability, the easier, to forecast a little bit than it is in the public space or maybe operating companies to that nature. So it's been a long and wide. I'm still learning though today, David. And, I'll say that I don't do everything right. I haven't, but one of the core values at Origen is just this continuous improvement and learning and doing things better. And I can tell you there's been an evolution to our firm over the last 14, 15 years. And I think we are way better today than we were 15 years ago, but we're better today than we were 2 years ago. And we were better 2 years ago than we were before. So you're never going to get it 100%. And what you said in my bio is so true, that you have to, making money is about taking calculated risk, right? Not just risk for the sake of risk. You have to take calculated bets, because if you don't, and you want to hide your head in the sand and you're going to leave your money in your bank account and just live off of it, it's going to disappear very quickly. So, I don't know if that actually answers your question. I mean, I've got plenty of war stories I can share with you as well.
Well, I think at this point it would be helpful for you to maybe just describe Origin and what you guys are focused on today, and give us a sense of the size of Origin, what you guys are focused on, what assets under management, that type of stuff, just so we have some context.
Okay. So we help high net worth investors grow their wealth, generate passive income streams, really through a variety of different real estate strategies, but it's all under the multifamily umbrella. And that's kind of the crux of what we do. So we operate, I would say that we build, right? We do development, we acquire core plus and value add assets, and then we also lend. So we have preferred equity. And we really have those three strategies, and we package them up into different funds. So from like a risk return spectrum, we have everything from an income fund to an income plus appreciation to just growth funds. And so the way we think about this is every investor has a different risk profile, a different time profile, but we're doing the same thing underneath as a strategy. And I will say, you and I were talking earlier, we're not really doing anything in the middle in terms of acquiring the core plus or the value add, because the valuations today just don't make sense in that particular area. We can get into that later. In terms of assets under management, we look at this. We have about 10,000 units that are either in some stage of development, but under control or stabilized. And then we represent more than 2,500 investment partners today. So we've grown exponentially. And that was really a result of adding digital marketing to our lead generation, going back to about 2015, 2016, because at that time, it was just David and I, and we were looking, to our network, and we were having lunches and we were talking to people, but we had a really great product and we knew it. And I think there's an advantage from not being in the industry, that we weren't afraid to take risk, right? And how we met people, how we did things. So we really grabbed onto the Jobs Act and the ability to market our platform, and our returns resonated with people. Our alignment resonated with people, our team, our strategy, everything. And over the years, it's just kind of grown organically, but we really grew from, I would say, 70 investors at the end of 2015 to more than 2,500 today. And a lot of that, is a result of just being a top decile manager, because our funds have performed extremely well over the last, decade. So that's kind of, what else can I tell you? I'm in Chicago. We don't invest here, actually. I just happen to be here. We have 4 other offices. So from an investment strategy, we're really in the Sunbelt states, Southeast, Texas markets, and Southwest. And what we do is we look for low tax growth states, and that's kind of, moderate temperature as well, just where everybody's moving today. And you can see, COVID certainly accelerated that entire demographic trend, but that's kind of the crux of what we're doing when it comes to investing.
I want to talk a little bit about the growth of Origin. What stood out to me is 2015, roughly 70 investors, and then massive growth since then to roughly 2,500 investors. Obviously, Jobs Act played a role in that. And you mentioned already digital marketing, but that doesn't happen naturally, right? There's some intentionality behind that. Maybe speak to a little bit around the growth. Was there anything in particular that you and your partner did to experience that growth, or was it just a combination of the market and that you guys had a good business model?
Well, it's a couple of things. Number one, I don't think that it was rocket science when you look at the world and how it operates, to say, if you have a good product and you put it in front of millions of people, you're going to get more buyers. And that was the simple notion. And we knew we had a great product and a great team, and we were always investor centric. And we've had people approach us and say, well, what's the secret sauce? What's this? And there's no magic bullet, right? You don't, it's not like you turn it on and it happens, but it always starts with having a really good product. And so we were fortunate, that our fund 1 ended up being a top decile performance, our fund 2. So when we started on our marketing campaign, we were raising capital for fund 3. So it grew from 70 investors, and then we had 450 investors in fund 3. And we really didn't raise any capital again or bring on new investors until 2019, because our fund 3 is all we had at that time. So, it's the market itself today is so much more transparent. And you have to be willing to kind of put yourself out there and open the kimono to the world and be subject to everything. And I'll tell you, like somebody in one of our investor relation associates years ago said to me, he said, you know what I love about my job is there are no gotcha moments, because investors approach everything skeptically, as they should. But I know what's in the PPM. And we always have this litmus test. Like if I, as an investor, don't think that's fair, then I don't want it in it as a manager. And I talked about alignment earlier, and it really matters. So it's it doesn't work for everybody, and not everybody is willing to really go out there and, you know, kind of show the world under the hood. But we were, and we took a risk and a chance, and it wasn't without some pushback from our team back then, but we kind of saw what the future was, and it's paid off immensely. And so, you know, at the end of, I would say 2018, that's when we were done with Fund 3. We launched a QOZ fund. We launched our next Income Plus fund. So we had 2 funds that we were raising capital for. Since then, we've also, just last week, we launched Growth Fund 4. We launched a credit fund. So it's really about meeting the demand from our investment partners and just packaging it up into different ways for their risk return profile.
When you were growing during that time, what were the biggest challenges that you faced?
Good, really good question. You always have the operational challenges, but again, I would say that we had a really good runway because we didn't grow much between 2017, 18, and 19. We had those 450 investors. We didn't have another product. So we had a lot of time to sort of ramp up operation, build during that period. But there's always unforeseen things. And certainly, I think we got a little bit lucky in 2015 because we partnered with a technology company who built our portal software, because there really was none back then. And they did an amazing job. And we were able to scale up and really service those 450 investors pretty easily. And looking back, I just can't, you know, believe how lucky we got with that group. Now, long story short, we've since moved on from that technology, but it helped us get through that phase. And you're always going to have operational growing pains. And then you have to make sure that you're growing at a measured pace, that you're not all of a sudden jumping into a sandbox that you don't belong in or don't want to be in, and that you're not losing your competitive advantage. So, you know, 2,500 investors, I do believe that we have grown in a way that it has been just extremely thoughtful, right? About who we hire, our strategy, how we continue to expand slowly. And by the way, like at times we've shut funds down. We've turned money away because we're like, look, it wouldn't be prudent for us to actually take in this money right now, because we have to make sure that we can invest it in a prudent way. Because when you're building a firm like this, anytime you're looking at in the long run, right, 5, 10, 15 years, you got to make sure that you don't make mistakes. And the number one rule of investing is don't lose money, right? And we've always adhered to that. And so it's just making sure that we continue to do good deals. Because, you know, even though people have been with us for a long time, you know, new investors haven't, right? So they only know the deal that they're getting into. And you have to make sure that they're having the same experience that everybody who came before them has as well. So there's certainly, you know, managing 2,500 investors is way more difficult, though, from an operational standpoint than it is 70. And you can imagine. So our IR department, which we really didn't have when it was, you know, David and myself, you know, 6, 7 years ago, we have 12 people now dedicated to that department, between the onboarding, the client service, the capital raising, the, you know, investor relations on that side. So we've definitely ramped up, but you have to.
Yeah, absolutely. So moving forward, and I want to talk a little bit about your perspective of, you know, what's happening in the market. Where are the opportunities that you're seeking out? We talked about, you know, you guys focused on development. When is the last time that you guys acquired existing, or are you only focused on value or development at this point?
At this point right now, we're only focused on development. In terms of the last time we acquired like a value add deal, that would have been in Fund 3. That was probably almost 3 years ago. So 2.5 years ago. So yeah, it was quite a while ago. And the reason is for what you and I discussed earlier, which is the valuations on existing products. It's so incredibly inflated right now. I mean, we're seeing some multifamily trades, newer product come out at $350,000, $400,000 a door when the replacement cost is $235,000. So we'd much rather be in that building. And what that's doing is it's pulling up the class B, it's pulling up the class C, everything. And we're looking at sometimes products that are 15 years old that are trading at or above replacement cost today. So we can't make sense of it from that standpoint. You can always make sense of it on Excel, but fundamentals prevail over time. And there are distortions in this market, and we just want to make sure that we're protecting ourselves. And the way you protect yourself in real estate is either A, by capital structure, right? So we have preferred equity. That's one of our products out there, and we have plenty, 15 to 20% equity above us, or through basis. And the only way to get into a good basis today is through development. That wasn't true 6-7 years ago. You could have bought existing product for 30-40%, and it really made sense then. And today, it feels a little bit strange. And I'm not saying that people who are in core plus or value add won't make money. I just believe if you're in that, most of the meat has been taken off the bone. And I think if that works, development will only be that much better. And that's so we're more of a barbell approach today in terms of what we're doing. We do, our strategies are more buy, fix, hold. So within our funds themselves, we actually have, sort of core products, but that's more a function of build to core than it is, buying those brand new.
Interesting. And so what's on the horizon in this world of multifamily? If you're focused on two questions. Let me start with this. Was there a transition period when you were making the transition to development from existing value add or core plus, where you had to help your investors understand a new investment strategy? And was there any challenge around re-educating your investors about strategy and when you started to make a transition into development versus existing?
Yeah, a little bit. There's an education, and I'll go back. I mean, it happened organically. And so Fund 3 had a what I'll call a frontier sleeve for development opportunistic returns. We had that from the beginning. So our investors were already comfortable with the development going, from Fund 3 going forward. And when I say it happened organically, we just kept looking at these core plus value add deals and looking at the basis. And over time, you saw them creep up. And we're just like, look, we don't want to be there. That's not where we want to be. So, in something like our Income Plus fund, we didn't have a development sleeve. And we went out to our investors and we had a webinar and we made the case for why we should have 20% of our fund's capital earmarked towards development. And we had talked about this years ago. And I remember the feedback we got from some of our internal people. We were like, look, people are not going to be, they're not going to like this. They didn't sign up for this. This is really a lower risk, moderate risk profile of a fund. And these are income seeking investors. And we go, yeah, but we're just not doing them justice if we're taking their money and going out and buying core plus deals. Like we're just not going to take money then. And so we went out to this webinar, and not only there wasn't a single person, by the way, we've got 700 investors in that fund. There wasn't a single objection. And in fact, it was the opposite. Why don't we do more? And some people were fine also saying, hey, I'm cool with this as long as we're at 20%. That's what we came out with. And that's what we now adhere to. So it was an educational process, but we do a lot of webinars and communication with our investors to educate them on what we are doing and how we're doing those things. And when you think about risk, right, our job is to de-risk the entire process. And that's why we have a team. We have experts who go in there. They understand the development, how to evaluate these things. If you're an individual investor and you're looking at a development deal, you don't have a team of 15 people who are trained, for the last 20 years in real estate to help you evaluate the merits of that deal, or to see 50 deals out there and choose the one that we believe has the highest risk adjusted return. So that's, I think, the value that we provide for a lot of, our LPs out there, is that we de-risk the entire process from A to Z, when it comes from development, identifying the deal, all the way through the management. So there was some, back to your question, education, but it was surprising how they were just like, yeah, we're good with this. So.
So you've got, rough numbers, 10,000 units under management, and those are at different, stages of the process. How do you stay motivated? What's on the horizon for Origen, and what drives the company at this point in time? I mean, you could probably sit back and say, hey, we've had a really good run here, and enjoy what you've built. What keeps you going?
Well, David, that's one of the better questions I've gotten on this. So it's interesting. And I would say in the very beginning, and I alluded to this, what drove me was a sense of fear. Oh, my camera just went out. Let's see if that's
all right. There you go. Yeah, you're back.
Of running out of money. And I didn't want to do that. And literally, I think that I was a little bit obsessed with, like building Origen, building a firm, building a place where I could invest, my capital. And so was my partner. And we would, constantly, like, it didn't matter what time of night, if we had an idea, we'd share it, deals, things like that. And over the years, I've sort of like, okay, well, I'm past that stage now, right? I'm cool here. I've got, my real estate. We've got a great organization. And I would say, like, during that evolution, it became more about, really building the company and helping the team and advancing and our investors too. And I really enjoy, like, having these conversations and hearing from investors about, what we're doing for them and how they really, like, used us in the same way that, was designed for, right? Which is to grow their wealth and do everything. And so, there's a lot of satisfaction I get from the day-to-day running the business and seeing the joy that it brings on our team's faces, just these small victories and their advancements in careers. I mean, right now we're at the beginning of the year, we're going through reviews, and, I don't love reviews, but I actually like them when I'm in there because I love our team, and, they're really, really good. So I think there's been, I don't really need a lot of motivation. I think it's in my DNA to work, to want to create, to want to do good. And so I feel really, really proud of what we've built. And I have a sense of, I don't know what you want to call it, just, responsibility to our investment partners and the promises we've made, and also our team. And those are the two constituents that right now matter to me. My family is obviously first, but they're taken care of and they're good. So within the Origen ecosystem, it would be, our team and our investment partners.
Love that. Well, look, I want to be respectful of your time. I want to start winding down here, but I want to get your thoughts on, where we're headed in this market. Things are, we're at a crazy time. There's a lot of opinions being thrown around. Just interested in your general thoughts on, what your outlook looks like in the next 2-3 years.
Yeah, I'll give that to you. I tend not to do the crystal ball questions. So,
okay.
I tell everyone, there's pundits out there who talk, they claim they know the future. I can only tell you, like, where we are currently based on my past experience and what I can extrapolate from that. And there are major distortions in this market, and we see it as a result of COVID. And we've seen in some markets like Phoenix and Tampa, in Austin, where rents have gone up 25%. And that's not to say they're going to go down. Certainly a lot of that future income has been brought forward, because what happened in COVID was really an acceleration of a demographic trend that's been happening for 3, 4, 5 decades, where you have northern, migration from the north to the south. And that has really accelerated. So we've never seen growth rates like this. I mean, you're talking about 5, 6 years of growth that happened in 1 year as a result of COVID. Now, we have actually artificial intelligence models internally that we built. We hired 2 data scientists about 2.5 years ago to build these things. And everything we're looking at says that there's still growth on the horizon in these markets, that this isn't going to just be a vacuum and disappear. Now, you're not going to see the 25% growth, because one of the factors that we look at, and even that the model captures, is affordability. So in markets that were extremely affordable are now a lot less affordable, right? When you jack rents up by 30%. But you also have to understand that a lot of those incomes now have been imported, right? You have San Francisco incomes that have gone to Phoenix, and you have New York incomes that are going to Tampa. And so the whole model looks very different when you start to look at affordability, because somebody who was in New York making $300,000 now moving to Tampa, they can afford a lot more rent, but people in Tampa are being displaced. So I think that you're going to see this evolution of the market sort of calm down, and you're going to see the winners and losers. And I do believe, from what I said this earlier, that replacement cost matters. So if you're positioning yourself today, that you really need to think about that and look at, if you're getting into Class B and C, what is that relative to today's replacement cost, and just tread lightly, be careful. So I'm optimistic about the future, but we are still protecting ourselves at all costs right now.
Yeah. Well, I've got one more question. I was going to let you go. I got one more question. That is, do you have any? Is there any? Do you feel any pressure to explore other asset types? I know that you've explored into development, but you're still in the multifamily space. Have you considered, and is there any exploration of other asset types as the market starts to and continues to shift?
Well, we were in office and retail before. Even Fund 3 had a component of office to it, so we actually got out of that. And I think as a firm, the idea is that we're going to continue to specialize and really be experts in that. And we can move geographies because we're more of an investment management model, where we're not a sponsor on the ground. We don't have developers, or a regional model, if you will. So if things start looking a little too frothy in the Texas markets, then we can move to places like Salt Lake City and elsewhere. And we are going into Salt Lake City. So our model is very dynamic. And I do believe that multifamily is not at risk of being disrupted by the internet. So when we're looking at sort of the two asset classes that probably have the best, 10 to 20 year outlook, it's still the same. It's multifamily and industrial because of what's happening at a very high level. So there's no immediate sort of push, but I would say that within the world of housing, something I think about is that you have a lot of different sectors, right? Within the world of housing, you have your traditional multifamily, and that's kind of what we've been in. We've been in garden and wrap and podium. And then you have the horizontal multifamily, which is more, looks like townhouses spread out. Then you have age-restricted multifamily, and you have senior housing. And so even in the world of housing, there's major expansion that we can go horizontally. We have enough right now on our hands that we're really focused on executing what we're doing right now really, really well before we add anything else on in the future. But certainly we could go in that route.
Yeah. Well, look, this has been a great conversation. I've enjoyed, hearing your perspective. You obviously have a great background, and you guys have built an incredible company. And it's always nice to have someone come on that can articulate their ideas and concepts and how they built things and what they're looking for in the future. So appreciate you coming on and just sharing your journey with us. Before I let you go, what's the best way for our listeners to connect with you and learn more about what you guys have going on over at Origen?
Go to our website, origininvestments.com. We make it super easy for anybody to connect with us right there on the website, or download any of our decks or information.
Okay, love it. We'll have a link to that in the show notes. If you want to connect with Michael and his team, go down in the show notes right now, click on that link. And Michael, again, thank you for coming on. I really enjoyed our conversation, and I look forward to staying in touch down the road.
David, thank you for having me on. Appreciate it.